right beside mine, but Matt more recently has transitioned into the property partner at GRA.
Not working.
Spends most of his time out with clients, helping them build their portfolios, looking at client properties and deals, and also managing his own stuff. We've got a culture at GRA of doing it and helping clients do it. And so Matt's going to run through that with you all tonight, give you some examples of his successes and GRA's successes and exactly what we've been doing and what we're recommending to clients. I don't know if you're aware, GRA spends a lot of time providing education to clients, teaching clients, so the better you do, obviously that's great for you, but it's also generally great for us. Okay, so Matt, over to you. Thank you.
Thank you very much, John. Can everybody hear me okay down the back? Very good. Okay, well, thank you and welcome everybody. Amazing turnout. We put 900 seats out and we're using most of them. I think we filled the car park, so, fabulous turnout. Thanks to our sponsors for the evening, firstly B&Z for helping us with Tony. We really appreciate and respect that. Chris Peterson Mortgages, who have helped put this evening on, and Property Ventures Real Estate, and even a wee bit from my sister Megan Jaffe at Ray White in Memawera, who has put some people in the room for us. Thank you very much. This evening I'm going to be talking, if I can get my clicker to work, about the property market. As some of you will be aware, I have my own commentary on what's going on and my own views and philosophies that underpin my investing and how I approach portfolio building for myself and my client base. Much of that is set out in my book, Property 101. I just had a client come up to me and say that he bought the book in a bookshop and he wasn't going to buy it because it said Property 101, but he bought it anyway, he read it, and he just told me that he thinks it's much more than 101. And that was a purposely understated title. Basically, nobody can criticise me because I can say, well, it's just 101. But it's a lot more than 101. So if you get the opportunity to buy the book, it is a good read. It's 500 pages long, and there's lots of good information in there. So let's start with the market update. And if my clicker can work, probably take a step back and say 2013, 2014, if you went out into the marketplace and threw a dart at a property and bought it in Auckland, you did well. And whether you picked the market because you could see it had great fundamentals, or whether you were just getting on the bandwagon with everyone else and you purchased, you've done well because the market's been hot since the bottom of the global financial crisis. Auckland's been absolutely thriving. If you look at the market at the moment, I think you need to be a bit more cautious. I'm particularly suspicious of a market when you start to look at yields and say, these yields don't make sense. And a lot of property out there, when you go and look at the investment and you see net yields at 2% on properties in Auckland that are traditionally rental properties, that gives me concern. And I ask myself, well, what will an investor be doing if we have some sort of global shock event and we see interest rates jump from 5% to 10% for a period of time? Maybe we see sovereign default from a country. Tony was talking about the European countries with particular concern over their banking systems and their economies. Spain's banked out of France, France is banked out of America. You get a domino effect if that sort of scenario starts to unwind. What if we see another large institution, Lehman Brothers, reoccur, and we see interest rates start to climb as a result of interbank lending pressure? These sorts of things are unpredictable, but they seem to happen every once in a while. And when they happen, banks are suspicious of each other because they're concerned that the other bank's insolvent or lacks financial capacity. So they put the rates up to reflect the increased risk of interbank lending. And of course, we as a net borrower, as a country, import that as an increase in interest rates, and that results in pressure on the whole population, reduction of consumption, because everybody's paying the banks instead of buying TVs and cups of coffee and that sort of thing. So you look at what's going on right now with net yields at 2-3% in Auckland. And you say, well, what are the investors who are entering the market at this stage going to look like if interest rates are 10% for a while? And it seems that every decade that happens. Maybe this time it's different. Maybe this time with a backdrop of quite deflationary flat pressure offshore, we do have a sustained period of low interest rates. But you have a shock event, you have a change of environment, and all of that changes pretty quickly. We have high interest rates. So with that in mind, if I'm going to go and borrow large amounts of money, which I do, and pump that into the market, I think to myself, I want to be in a market that is less volatile. And I want to manage the risks of the interest rate fluctuations because I'm carrying all that leverage in my property portfolio. So the fundamentals I want to see if I'm going to borrow lots of money and get into the property market, firstly, I want to see population growth because that's demand for housing. And as Tony said, if you have 3 people move into the Auckland market, they form one household. The average number of people per household in Auckland is 3. So we have phenomenal net migration into the country, 60% of that's hitting Auckland, and also the population's young, it's breeding, its organic growth is absorbing a lot of our local land supply. Just the organic growth is nearing our capacity to build housing. When you add the peaks and troughs of net migration over the top, it's even more phenomenal demand. So but this model is talking about any area. You can apply this model anywhere. If you've got strong population growth, you've got household formation happening, that's absorbing housing supply, it's a healthy, thriving market. Of course, if you're seeing population growth in an area with loose land supply, because there's sections everywhere, you're not going to get asset value growth. So another fundamental I want to see is tight land supply. If you go into small town New Zealand, most of the properties have big backyards. It's quite inexpensive to do a subdivision out of Auckland and just lop that back section off so you've got loose land supply everywhere. You come to the main centres, Auckland, Hamilton, Wellington, less so Wellington, but you go to the main centres, you've got very tight land supply. And that means that if the populations are growing, they're growing in an environment that's tight for supply. It's inflationary for house prices. And the third thing that I want that I think people often miss is high average incomes. And that's because when you get shock events and interest rates come up, then that sorts the stronger investors from the weaker investors. If your household's on the breadline, money in equals money out, and you're managing to survive, and interest rates double, and you've borrowed $1 million, so you were surviving at 5%, and now interest rates are 10%. Well, when your fixed interest contracts come off their fixed rate agreement period, then your household's upside down for cash flow. But less so if you're in an area that has a base of affluence, real wealth there, and high average incomes. So these are things that I want to see when I'm investing. Now, another thing is if you have high average incomes, you of course can have more inflation of house prices because there's more capacity there to surplus cash capacity to either pay a larger mortgage for home ownership or a larger rent as their rents go up. And as said, it's decreasing volatility. So you look at Auckland net migration versus rest of New Zealand. The blue is Auckland, rest of New Zealand is brown. You can see Auckland's 60% of those migrants coming in. It's hitting the Auckland catchment, which is just phenomenal. And you go back over the years, that's been pretty consistent that we're over 2/3 of the net migration is actually being absorbed into Auckland. So you then say, well, what about Auckland population growth versus rest of New Zealand? Is this a new thing? Have we just discovered migration? And has Auckland just suddenly become the largest population in the country in recent times? And you go right back to 1926, and you can see that we hovered above the rest, but just post-World War II, the Auckland population cranked ahead of the rest of the country, and it's continued into the stratosphere. It's Auckland on its own. So this is a long-term trend. Auckland's just getting bigger and bigger and bigger. And of course, compound growth, as you get compound growth on a bigger population, the amount of housing you need just from organic growth, from the city growing, is absorbing the capacity of the city to grow its housing stock. So net migration's a bonus. So what I've done is graphed in my book demand, which is the blue area, number of people moving into Auckland divided by 3, and put against that the supply, which is the red line. Supply is the issuance of building consents. Now, not all those building consents actually get built, because people get resource consents and land bank them, they just sit on them. So it's a little bit misleading in that the red line's overstating things a little bit. But you can see that the blue line is, since 2005, in Auckland, far above the red line, and that's pent-up demand. The supply of housing is getting tighter and tighter and tighter as the population growth exceeded the supply. And of course, we can cast our mind back. We had the financial crisis. All the finance companies went broke. All the developers nearly went broke or did go broke. Everybody had, very little appetite to develop the housing stock, yet the fundamentals of supply and demand were very, very good. So back there, that's what was going on. And now the developers are getting credit back and getting enthusiastic. You can see the resource consent applications and building consents being issued, and supply is trying to keep up with demand. If you look at the quarterly data, which is that graph there, you can see that in recent times, actually Auckland's cranked it up even faster. So it's going faster at the moment. And since, if you look at volatility, in 2007, the peak of the the commencement of the global financial crisis and the former peak value, Auckland fell only 4% on CoreLogic data if you have a rolling quarterly median. So I have seen data with spot numbers from REINZ. If you take the lowest month when there was almost no turnover and really the only people selling were distressed, then I've seen minus 11% in the middle of it. But I think that data's kind of misleading because there was low volume in that month. And if you have a rolling quarterly median, it's a better quality indication of what's going on. And in fact, we only went down 4% on a rolling quarterly basis. Since the bottom of the market, which was very early on in 2008, we are 75% up off that bottom of the market, and we're 68% up on the former peak value. So you can read that two ways. You can say that's phenomenal performance, Auckland's amazing, but you can also say that looks a bit scary. If you're a contrarian investor, you're buying at the bottom and easing off at the top, waiting for a turn in the market. So you can read that both ways, and I do read that both ways. I have some concern about that as an investor. Just like you guys, I borrow lots of money, and or some of you guys, and I invest a lot. I've got 26 properties in Auckland at the moment, if you count them all up. A lot of those are subdivisible, and I'm in the process of subdividing them, so some of them are 1 into 3, 1 into 4, that sort of thing. So I have particular interest in this stuff. I like to pick the peaks and the troughs so that I don't get hurt, and that flows through to the advice that I'm giving my clients. Looking at Wellington, you see, just struggling to read that, so I'll go back to this side. You can see that Wellington was pretty similar in volatility, going down 4%. Is that 4? Yep. And it hasn't yet had the recovery, but it's got a nice sort of linear increase in confidence there. It's up 17% off the base and 12% over the former peak value. And this has been sort of slowly emerging since 2011. And when you look at housing supply and demand, the consents are down and the demand is up. So those are great fundamentals to me. It hasn't yet taken off. It's starting to take off, and it's got tight supply and great demand. And in the last quarter, actually, the consents went through the floor, as in the developers stopped for some reason down there. So that all looks good to me. So supply, demand, I like those two factors, but what about incomes? Well, Wellington has the highest average incomes in New Zealand. So there's another tick. So I think that market's great. Good place to be looking at the moment. Is a quake zone, so be careful about buildings that could be quake affected. Christchurch has peaked, and funnily enough, we've got a lot of clients in Christchurch that are reporting that the rebuild of the housing stock has pretty much been concluded with the Earthquake Commission. The CBD's still got to be rebuilt, but that's all big, big company stuff. Fletchers and so forth have those contracts. The little guys are all really losing their ability to maintain employment down there, and they're coming back to Auckland. We're even seeing a little bit of insolvency down there. It's quite recessionary in the trades down there and the supply chain for the construction industry. So, that's the feedback on Christchurch. It's not a great vibe. If you look at the supply-demand graphs, I should comment that these demand graphs just look at international migration. And the reason why is the internal migration, you can't actually gauge that, or maybe Tony's got the data, but we can't get that data. I've got a contract economist that works for me and gives me this data, and he said you can get long-term trends, but they're pretty unreliable in the short term. So we're just looking at net migration versus supply, and in Christchurch, supply is far out outstripping demand. But if you look at that dip there, that's the 10,000 houses that got destroyed in the quake. So a lot of this excess supply is actually replacing the red-zoned houses that disappeared out of the market. Hamilton, it's quite similar to Wellington, I think, in that you've got a market that has started to take off in the last 12 months, but I like it because it's got tight, balanced or tight supply versus demand curves, and it has high average incomes. It's sort of a vibrant, diversified economy, becoming a satellite city to Auckland. A lot of Auckland corporates base their manufacturing or pick and pack logistics, that sort of thing, down in Hamilton, and have their head office in Auckland operating up here. So with the cost of land in Auckland, it kind of makes sense that you satellite down to Hamilton. So as a result, you have enormous diversity in employment down there, quite high average incomes, tight demand, and you're getting that sort of ripple effect out of Auckland, people moving there because it's got good employment opportunities and it's not a bad place to live. Tauranga is also taking off. I'm quite suspicious of Tauranga. You might have heard the saying $10 Tauranga, which is a bit rough, but in Tauranga, they say that everybody's paid $10 under the table in the bars because they can't afford to be paid the minimum wage. The bars are so tight for income down there. And when you go down there as a professional, which GRA has sent me down there on occasion, we interview the locals, and I'm always astonished at what they earn. I mean, they survive on nothing down there. You have a household where somebody's supporting a couple of kids, putting them through school, and they've got a spouse, and they're on $50,000. Try and do that in Auckland, but you see that quite frequently down there. So you sort of look at Tauranga and you say, well, what happens when interest rates have a shock? And they're all enthusiastically investing in their cost base that they're investing in. It's going up and up and up. And suddenly interest rates go up. They just don't have surplus household cash flow to deal with the shock in interest rates. So I see areas like that as volatile. Everyone speculates and increases their investing activities down there, but they're doing it on a very low income base. Of course, you do have a downshift coming out of Auckland. Auckland baby boomers cashing up their McMansions. They sell them for $2 million in Remuera. And they go down there, they buy a house in Pies Pa for $800,000, and they put $1.2 million in the bank. And the problem with that population is they're sitting in cafes on iPads and they're Skyping their kids and they're reading the Herald on their iPad and they're just defending their money because they're retired. So that $1.2 million they put in the bank, they're living off it. They buy a house, a couple of 2-year-old cars and live a sensible life, They're not down there to grow the local economy, to invest, to create employment, to create growth. They're a very defensive sort of part of the population. So they absorb the housing supply, which is part of this 37%, but I don't see them as a very productive part of the economy, and there's a lot of them going into Tauranga. So Tauranga housing supply and demand, you can see that this graph sort of shows the issuance of a lot of resource consents, but demand is nowhere near the resource consents. That's because the missing bit in the demand in these graphs is internal net migration flows, and you get a big bounce out of Auckland with baby boomers going down there that closes that gap. New Plymouth, I threw that in there because I was quite surprised. I've got all of the cities and all of the small towns, and that was a standout performer. It was actually not particularly volatile off 07 down to the bottom of it, and it's really been going gangbusters since 2011. It's doing pretty well. Whangarei would be the worst of it. I found this graph amusing, so I threw that in there. It went down, it went up, it went down. They didn't know what they were doing. Really low volumes. and it hasn't come back up, basically. That's the moral of that story. We haven't got back past 2007. And if you've been there, you'll know why. Okay, it's a bit tough. Tutukaka's lovely. I'd go live in Tutukaka. Now, housing stats misleading. You've really got to watch your housing stats because look at this one from CoreLogic. It seems that everything's pretty much in the middle of the pack there. There's the average of New Zealand, the black line. The red line is Canterbury, and Wellington, the yellow line. And Auckland's a wee bit better than the rest, isn't it? But it's doing better. But when you actually say, well, what's in that black line? What's in the black line? All of New Zealand. Auckland. Well, let's take Auckland out and see what it looks like. Here we go. The black line is the rest of New Zealand. The silver line is Wellington. It's not keeping up with inflation. This is inflation adjusted, but it's starting to catch up. The red line is Canterbury, and Auckland's 41% up on 07. So if you look at the former 2007 peak and carry it through, it's an interesting story. And for me, fundamentals sort of play out in this. The areas that are more volatile are the one-horse towns with low average incomes that don't have the vibrance of employment, the population growth, or the tight land supply. And that's really a very good starting point to avoid being caught in this black line here. Just invest in areas with those good fundamentals. So a key takeaway point from this is that Auckland has a fabulous tight supply, bulletproof demand, and this is reducing your risk if you are putting your money into the Auckland market. But real point I want to make here is don't just think about the buoyant times. Think about what happens when interest rates jump to 10%. And there's nothing to say they're going to. But you've got to be a survivor in the down cycle. If you're a 10-year investor, you've got to survive those down cycles. So my advice is don't be greedy and take the one-year fixed interest rate on everything, because if interest rates spike up off a global shock event, you'll go broke in 12 months, maybe. Take some long money and do the maths on what you can withstand as a household, the gap between what you're getting in from your rents and interest rates, and what interest rates might do to you if they hit 10%. And make sure you're a survivor. If you're not a survivor, if you don't have the income to cope with it, use long-term fixed interest contracts. So Auckland's peaking out, and our yields are looking a bit crazy with a lot of residential property with net yields of 2%. That net yield's rent minus operating expenses. So is it time to leave Auckland? Auckland now has, higher. You need a higher deposit. Your LVR ratios are at 70%. And Auckland's experiencing this ripple effect where just through sheer lack of affordability, everybody's disappearing to Tauranga and areas like that, seeking a more affordable life. And of course, timing. Auckland, traditionally, if you look at the boom cycles, Auckland booms first. So Auckland's getting that easing off, and it kind of makes sense that the regions will catch up. Historically, if you look at Auckland's peaks, it goes first and the regions catch up. And that's happening at the moment. And that you've got the spillover population flow from Auckland happening as a factor. So with all of that, you can get 80% out of Auckland, 70% in Auckland. A lot of people are leaving Auckland. That's population growth for the regions. Is it time to leave Auckland and plough into the regions? And what I would say to you is, as long as the area has good fundamentals, not a bad plan, it's obvious you're going to get growth in those areas. In the short run, you're going to get catch-up and affordability, and you're going to get the benefit of these LVR rules. But what I would say is, if you can make Auckland work, and you're a long-term investor, Auckland's going to stand up. It's got phenomenal fundamentals, restricted land supply, bulletproof population growth, high average incomes, all of that stuff is tick, tick, tick. So if you can make Auckland work, why not stay in Auckland? So let's talk about land supply. And when you talk land supply in Auckland, you're talking about the Auckland Unitary Plan and the rezone of the land that we have in Auckland. And what's interesting about the rezone of Auckland land is we're not hitting the land supply targets by rezoning Auckland that we thought we were going to. Various forecasts are in the Unitary Plan, But basically, 700,000 to 1 million people is the forecast population growth in the next 30 years. So that's somewhere between 280,000 to 420,000 dwellings required, depending on whether you've got 2.5 to 3 as the average household size, and depending on whether it's 700,000 or 1 million people. So there's different models showing different things. But the actual land supply that's estimated that's coming out from the rezone of all of Auckland, on February the 28th, a new numbers come out that actually we're only going to get 80,000 new dwellings out of the Auckland Unitary Plan. And we need 280 to 420,000. So that is very interesting, and it's quite recent. So that's a deficit of 200,000 homes. Short run, when these new zones hit the land supply, there's going to be lots of stock emerging. It's definitely coming. 2016 July is when the decision from the independent review panel comes out. So we'll start to see land supply emerging from the last quarter of this year as that zoning becomes available. It's 5 months to get a resource consent. It's 5 months to build something. So 10 months later, you're starting to see that the benefit of that land supply hit our housing stock. So maybe 2 years' time, you'll see full throttle land opening up. But as the low-hanging fruit gets picked, the stock that has good services under that new zoning gets absorbed, which will happen very quickly on the current growth rates of Auckland. You can see if we've only got 80,000 houses, that's going to disappear in 5 years or so. Another thing about the Auckland Unitary Plan is as they release land to the housing markets, I think the new elephant in the corner is not the lack of land supply, because we're going to get land under the Unitary Plan, but the lack of services. Plainly speaking, if you've got 10,000 people in a suburb and the sewer pipe's this big, and you suddenly want to put 50,000 people in that same suburb because you're intensifying the land use through terraced housing or high-rise or infill into backyards, well, with 50,000 people, you're going to need a bigger pipe. How long does it take to dig up the sewer in all of these affected areas that have been rezoned and intensified and put the infrastructure in? A very long time. If you had all of the money required to do the services, it would take at least a decade before you start to see the infrastructure through Auckland completely redeveloped. But the problem is everyone's fighting over who's going to pay for it. Councils say to the developers, if there's a shortage of services, you have to put the new sewer mains in. You have to put the new stormwater in. One development I was involved in, and I was one of many, it was a syndicate, was a 500-lot subdivision in Alfriston. And Viola wanted us to put $15 million into the provision of new stormwater, and that was enough to service 2,500 houses, but we were 20% of that. And yet they demanded that we put the whole infrastructure in. So this is just absurd, and it's a restriction in supply. What you need is central government to come in and fund that and then recover it out of the developers as they connect to it. But at the moment, that capital's not there, so you have a standoff between the utilities providers and the developers. So this is all restricting land supply. You could look at that two ways. Socially, it's a disaster if you're trying to get into the housing market. If you're an investor, it's great news, because it's pushing up house prices. It's terrible behaviour, though. So this Auckland Unitary Plan notification process that's going on, remember the Auckland Unitary Plan is not in place. The next step is the independent review panel will make a decision in July or August this year, and they can change the rules. So we've notified the plan in 2013 of what we're going to do to increase the land supply. There's been public consultation, then all of that finishes and the independent review panel makes their decision somewhere between July and August this year. Then the plan becomes operative. And that, plainly speaking, means we've got land supply. Of course, at that point, we'll have an appeals process. So elements of the Unitary Plan will be appealed, and that may slow down the speed at which you can use the zoning. And so you're going to have this quite complex period where you've got the existing local plans operating and the new Unitary Plan operating. That's going to make the complexity of land supply hard for developers and town planners. But that's what's going to happen in the next 12 months. Once that appeals process comes out through the Environment Court, then we'll have one district plan for all of Auckland. Things will be much simpler, much easier. Here's the interesting thing for investors, okay? Because I don't want to bore the hell out of you. I know you're thinking, what the hell is he talking about? That's all, ho-hum stuff. But there's money in this information. So that's why I'm here tonight to talk to you. How do you commercialise this information? Now, what's not public is the new zones that council want. You've got to dig to get them. Because if you ring up council right now and say, hey, this urban area, what is the potential land use in this urban area? They might say to you, it's 1 per 300. Or if it's suburban zoning, they'll say to you it's 1 per 400. That's what the person on the phone's going to say. And if you look up the information online, you're going to see 1 per 300 or 1 per 400 as a density control. So you're thinking, 900 metres site, 300 metres, maybe I can get 3 houses on there. It's actually a net site calculation, so you'd probably need 1,000 metres with drives and things. But actually, when you dig into council evidence that's being put through to the independent review panel, they've said, we've cocked this up. We've only got 80,000 houses, we need 280,000. So everything that we've published online and consulted with the public on, forget that, it's not going to work. Here's what we want to do now. That's the information you need, because that's actually what's going to happen, or we'll have an absolute disaster with our land supply. So, for example, and I put quite a few of them in, but I'm just going to show you these ones. Mixed housing suburban, which is showing 1 per 400 publicly at the moment, is actually 1 per 200 under the council evidence. So instead of it being on a 1,000 metre site 2, it's 4 or 5. And if the site is over 1,000 metres, then the suburban zoning becomes unlimited for density, just as much as you can cram in there, satisfying other development controls like traffic and circulation, height in relation to boundary, height restrictions and so forth. So this information is incredibly valuable to you if you're in the marketplace buying stuff, because other people don't have it. Yet it's actually publicly available, you just got to know where to look. It's in council evidence. And this is something that we're working with a lot of our clients on, because this information is gold. Real estate agents don't know this information, and a lot of developers don't know it. So why is this rezone interesting? Because there's lots of money in land at the moment, and the vendors are often not understanding this, and they're underpricing subdivisible land as a result. Let me give you some examples. This is a property that I bought last year in Woodglen Road in Glen Eden. It's a 960 metre site, it's urban zoning. So at the moment, I can't do much with it, maybe 2-lot subdivision. But after August, it becomes urban zoning. It's under 1,000 metres, so it's unlimited zoning if it's urban zoning now, under the new plan. So that means if I can make the development work with 3 or 4 or 5 houses, then the council will give that to me. So of course, when the vendors sold this property to me, they were heading to Tauranga. They were a downshifter. So they were going to cash the house up at 730 grand or whatever I paid for it, and pay their mortgage off and get a freehold property in Tauranga and move to Tauranga. They weren't thinking, maybe this is a subdivisible property. And they certainly hadn't worked out that the urban zoning had changed. So I get 3 lots on that site. I lift and shift the house at the front to the back. I put 2 houses at the front. I build something like this, a couple of brick and tile properties at the front, straight onto the street. And if you do the maths, and I'm not even going to try and read that, if you do the maths, there's actually $600,000 minimum margin if I price the houses at $800,000. And of course, I'm getting capital growth on the whole lot while I sit and wait for the zoning to change. And I would say I'd comfortably get $825,000 on those houses now, so there's another $50,000 in it. So squinting, I think there's $640,000 development margin in that site. Now, what's a little bit unusual about me as developer is I pretty much hold everything I build. And I've got a couple of mates that I invest with, and a couple of other guys that syndicate with me, and they're all buying into this philosophy because they can see the benefit of it. If I buy, build and sell 3 properties and make $600,000, when I sell them, I've got to pay the agents real estate fees, I've got to pay the IRD GST, and I've got to pay the IRD income tax. But if I develop to hold, I don't pay the agent. And develop to hold is exempt income tax and it's exempt GST. So commercially, I'm making lots of money because I'm pinching property cheap because the market doesn't understand the rezone. I'm making money because I'm subdividing, and I'm getting the additional commercial bonus of not paying real estate agents and not paying GST or income tax. So it becomes a really viable strategy if I can make the cash flow work. So what I do to make the cash flow work is I build the two houses and I sell the original house. So this is going to cost me 1.68 million, I think it is there. No, 1.6 million. I sell the original house for 650. I pay the agent to sell that house. And my net debt comes down to about 984,000. And my net yield of the remaining two properties is cash flow positive on that. I've got brand new houses and 100% financed. My development margin rolled into the stock that I hold is 62% LVR. So I'm 100% financed and I've got a 62% LVR. I'm cash flow positive, brand new houses. Anything wrong with that? So I have a dozen of these sites running at the moment. It's a really good thing to do. And we're saying to the GRA client base, get into this. Now, by the way, this is the same thing we told you to do 2 years ago when Tony and I ran this event. And I got up on stage, the video's on YouTube, on our GRA site if you look at it. I got up here and said, the vendors don't understand rezone. There's lots of money in land. Go buy large sites. If you came to the event, you would have heard me say exactly that. Same story now, just showing you some numbers. 19 Blue Spur Way, a property I bought only 4 months ago or so. Same thing, lift and shift the house, put two houses on the back, bit of town planning and kerfuffle with the neighbours and so forth. You look at this is just recent property. I think it's a good example because it's recent property. Paid $725 for it. It's going to cost me $600 to build. Subdivision and funding is about $240, and I've got to lift and shift the house in that. It revalues at 2.25, and so my developed LVR, 100% finance, so if I debt fund everything, I've got 70% on market value at the end, 30% margin, 660,000, no tax, no GST, no real estate agents, all good news. From a rent perspective, I'm down at about 5% net yield if I hold the lot, and I'm a little uncomfortable with that because if you build a mountain of debt on a net yield of 5%, it's not a good thing. I think that if you get a shock event, it's dangerous. So what I'll do is I'll sell the original house, and that'll leave me with the two new houses, and my rent on those will be about $58,000 to get my net yield up over 6. Now you're going to say to me, oh, but if you sell, you've got to pay some tax. You do, the tax is quite complex, but essentially because you're selling the original house, plus a portion of the land, plus a portion of the subdivision that relates to that house, plus the lift and shift, the sale of the original house is taxable, but you don't make any money when you do the maths. So you have a taxable disposition of land with no tax to pay. More good news. You do have to pay the real estate agent. So those numbers take into account that. Here's another one I bought last weekend. The agent that sold it to me is in the room. Same strategy as the above example, and I'm showing you this because it's current. It's current, it's everywhere. You know, there's a deal a day. I get this stuff flicked to me all the time to look at. So this is exactly the same strategy. It's a 1,600 metre site. The vendor of this property know that it's being zoned, but they don't understand the zoning. And you know, it is quite complex to get the information out of council of what the new zoning looks like. But it's 4 lot under the new plan. Pretty tough for the vendor and the agent to work out how you get to 4 lots, but it's got good services, and you know, it's difficult for them to work out what the value of that site is. So I'll do exactly the same there, make similar money. It's you know, just another one. So this is infill. This is looking in the backyards. What about going up? Bought this about 2 years ago with a couple of my mates. It's 74 Jervois Road. There's the Jervois Steakhouse just to the left. This is a little character villa. And that one is rezoned mixed-use business. So we can put a 5-storey building on that, something like that. And so the concept of infill is not just in your backyard, it's also airspace rights. So sort of broaden your horizons. The mixed-use business zones are particularly interesting to get involved in. Another thing to think about is if you want cash flow, just buy these properties, get resource consents and sell them. There's enormous demand for consented properties for new subdivision. Builders out there are building houses anyway. Why don't they build their own houses and make the development margin? If you're a buyer of a property with a resource consent, be really careful, because all the developers that get the resource consents want really unreasonable prices. Often there's no money if you buy it. You've really got to do your maths. But if you're the seller of the property with the resource consent, it's a pretty good market at the moment. So this is one that I did with my two mates. One of them's Saleesh Chand, who's a partner in Gilligan Rowe and runs one of our asset planning, one of our client bases there. The other gentleman, Adam, is in the audience too. So we bought this property only a year ago now. It's a 1,500 metre site in St Mary's Bay, north facing. And essentially our game plan here led us to getting a resource consent to build these beautiful townhouses, Darren Jessup Designs. And it cost a couple of $100,000 to get the resource consent, so it's quite an expensive and complex process. But we got a 4-lot subdivision, and we then on-sold it to some Chinese investors. By the way, the Chinese are back. Phenomenal demand at the moment from foreign investors. We had an enormous amount of interest in this property, and we ended up with somebody who was a front for one of the Chinese state governments, buying for them. I don't know what they're doing buying property here, undisclosed, but they were. And a very, very wealthy man who bought 4 properties like this in one day. He took 6 hours to do due diligence. 6 hours. And, wrote us a cheque for, signed it up a very big number. So these investors are incredibly wealthy, and they're buying up Auckland aggressively at the moment. Here's another land bank concept. This is a dirty old fitness centre in West Coast Road in Gleneden. And right next to it is a car yard. So we bought that. It's 1,600 metres. The train station's right behind it. So we bought the car yard and the gym right next to it. And what we can do there is put this very tall building. So we buy these quite scrappy little buildings that really have no appeal whatsoever, but from a cash flow perspective, they're washing their face. And so it's producing enough cash flow. But what's going up in value is this building. Now, if this building is developed, it's probably worth 13 or 14 million. And you say, well, okay, what's that worth in 10 years' time? Out there, maybe it's worth another 7% times 13 or 14 million. So maybe it's worth another $7, $8, $9 million. So that goes on what we can sell it for in 10 years' time. But our development cost doesn't go up by that much. Maybe construction inflation is going to do 3% over 10 years, but the end value, which is a bigger number, is going up at 7 or 8%. So you open up a big gap. That's the concept of a land bank. So if you've got a land bank like this that's producing cash flow and washing its face, you get very, very high capital growth on it, because that's not going up in value. What's going up in value is the building you can put on it. So that Jervois Road property, this property, it's all about land banking. Powerful concept. I sent an email out, but a bit of a cheeky email saying killer strategies. Right? Those are subdivision and infill concepts and land banking concepts. In the same space as relocatables. And I've got this relocatable project going at the moment. It's 9 Viola Road in Mangere, pretty, Mangere East, so lower socio demographics out there. And quite simply, what we're going to do, it's 1,150 metre site, is we'll subdivide it into 3 lots, and we'll whack 3 relocatable houses on it. In fact, one of the houses is the existing. We lift and shift and renovate it, and we put 2 new relocatables on it. So this makes really good money, actually. We originally bought it to build new houses on it. I was nervous about the end value of the stock, and thought, 800,000 is a new number out there, which was the end value. So instead, we decided to build second-hand relocatables, effectively. And you can see we paid $825 for the land, $300,000 for the relocatables, subdivision and funding's about $200, so it's going to owe us $1.3, and it values up at $1.9. 3 properties at $635. So there's $580,000, non-taxable, no GST, no real estate agents, all good news. 70% developed LVR, And rent minus operating expenses, $64,000, net yield's 4.9. So not the greatest net yield, but if I sell one of those properties and cash up a bit of debt, suddenly it's doing very well. So I hope that is a takeaway for tonight, because you go to so many workshops and there's all this ethereal stuff. Well, there's numbers, there's strategies. It's very simple. It's as simple as it looks. You just need to get good people around you, and you can execute those strategies, and your family should make lots of money. So I hope you can take that home and put it into action. Now, 5 things to avoid. First one is cross-securing your home to your investment property. If you have a shock event, you don't want to go broke. So this is more of a tax structuring thing. And so this is where we see a family home and the family trust, the rental portfolio in your rental company, and you go to your banker, your mortgage broker, your lawyers, and they say, let's just keep things simple. Let's have one bank that lends $1 million to the rental company, because that's how much money you need for your portfolio. And let's just cross-secure your home to your rental properties, because that's simple. One bank lending all the money to one company, but the bank takes security over the rentals and the family home. The problem with that is if there's a shock event or your household ends up on hard times, you lose your family home. So that's a disastrous way to structure your affairs. So a better way to do that is to have 2 banks. We call it a split loan structure. And this is where Bank 1 takes security over your home, lends the deposit to the company. So the deposit's deductible because it's in the company, but the security provider is your home and your family trust. And then your investment bank puts in the residual debt, in this case 80%, must be out of Auckland, 80%. So 80% is standalone over the rental portfolio. If you have a financial disaster, the Bank 2, of course, dip out. The maximum you can be exposed to is the debt over your family home, which is $200,000. So straight away you've got rid of 80% of the risk. Now if you buy a property, you're not going to go and buy a property at retail. You want to buy it at a bit of a discount. So presumably, combination of the discount, the value you add to the property, plus the capital growth, you end up with an increased value over time. So maybe it goes to 1.25 million. You then go to Bank 2 and say, can we have 80% of 1.25? 80% of 1.25 is $1 million, and you've borrowed 800 off them, so they give you a top-up of 200. With that top-up of 200,000, Bank 2's now lent you the $1 million. You repay Bank 1, and they're completely out of your life. So now you're 100% financed, standalone, over the investment portfolio. If disaster strikes, your kids and your spouse don't get kicked out of the house because it's tucked away in the trust. Key takeaway points for this: you need a trust to do this. You need 2 banks. You need supportive lawyers, accountants, and mortgage brokers that understand this stuff and will do it for you. When you hear people say, oh, let's use the KISS principle, keep it simple, stupid, you've heard that. What I'd say to that is sometimes simple is stupid. And if you make this stuff simple, it's very simple for the banks to take your family home. In the very affluent environment and credit-fueled environment that's out there at the moment, where it's easy to get debt and interest rates are low, it's easy to put the stuff in. You can't put it in when you've got the problem because the banks aren't lending at that time. You know, it's too late. So this is the time to be putting these sorts of structures in. And I know Chris Peterson Mortgages do this as a standard thing. They're very good people to work with in this area. Another thing that I would say to avoid is apartments at the top of the cycle. Apartments are selling at 10,000 a metre plus at the moment. And I'm just very nervous of that. Tony was talking about the students. Take the students away. Where are apartments? You know, they are absorbing the apartment supply. And you look conceptually at what an apartment is. It's a building suspended in airspace rights. What goes up in value, land or buildings traditionally? Land, right? And when you're buying an apartment, you're buying a building suspended in airspace rights. So airspace rights are, you've got 1/200th of the underlying bit of land underneath, and you get construction inflation on top. If you look at that conceptually, it should have lower growth than housing with land. So I've never been a fan of apartments. And you can smile and say, well, they went up 49% last year, because they did. And I got a couple of apartments. I bought them in the down market. But look at how volatile they are. The blue line is housing, and the orange line is apartments. They're volatile because when you get to the middle of distressed financial circumstances, GFC2, for example, hits, the banks leave the money supply on houses in Auckland at 70 or 80%, depending on if it's your home or investment. They still lend on housing in Auckland. But apartments get 0% in the down market. Last 2 cycles, LVR on apartments, 0%, because banks don't like them, especially the little ones. So what's the value of a small apartment if you've bought it, if you're trying to sell it or you're forced to sell it at the bottom of the cycle because the markets are distressed and banks are lending 0%? Only cash buyers, makes the asset value volatile. You get hurt. If you get forced to sell, it comes down in value. So I'm not a big apartment investor at the top of the cycle. I think the time to buy apartments is bottom of the cycle, when everybody's going broke, when the banks are lending 0% on apartments and they're cheap. So another thing to avoid is average houses at average prices in Auckland at the moment. I think they're too expensive. I think that we are approaching the top. Quoting Tony from years gone past, I don't know if he still says this, but I think it's gold. If you look back at the former peaks, 87, 97, 2007, the peaks are running in 10 years. When do you think the next one might be? 2017, all things being equal. And it feels very much like 2006 again. Markets peaked out, yields are low, everybody's sensibly looking and saying, gee, this looks high, but everybody's still piling into it. 07, no growth. 2008, it went into the downturn because everybody just stopped investing, saying, oh, this is no good anymore. So it feels very much to me like 2006 deja vu. And we're sort of reaching a point where maybe we get another 10% this year. Wouldn't be surprised at all to see that with migration picking up as it is. Maybe it goes an extra year and we get it 2 years in a row. But you go buy an average house, you're going to get the average. Why would you do that? Go buy a subdivisible property, a big block, a rezoned block, something you can add value to. Because if you add value to the property and you get an extra 20% out of the value you've added, and you can see I'm getting 30% routinely, if the market falls 10%, it's falling to what you paid for it, or, more, you've bought it for less than what it's falling to. So you're insulating yourself from a shock. Don't go and buy average. Go and buy something you can add value to. Another thing to avoid is one-horse towns and poor employment areas. If you look at the bottom 10 housing markets across New Zealand, they're all one-horse towns or towns with very low employment opportunities. Problem with a one-horse town, whether it's forestry, viticulture, dairying, when that horse is not operating, there's no employment. Everyone leaves town to get a job or stops paying their rents. Makes them quite volatile. So fifth thing to avoid is low-cost property in small towns. And you can read about that in my book. I'm a bit short of time, so I'll probably skip that. I've got maths to back all that stuff up. Now, just a quick couple of minutes on tax. Bright line rules are in, and you'll all be familiar with these. Property sold within 2 years is taxable. But another thing you might not have clocked is if you sell it and you make a loss, you get a deductible loss. So the gains are taxable if you sell a property within 2 years, but you also get a deemed loss if you sell a property within 2 years. That's useful. Of course, that loss is ring-fenced to other property if you can only use the loss against similar character income. So you'd have to have profit on other property to use the loss. Now, issues in practice. What we're finding is that people are buying properties in their own name, realising they should use an LTC or something of that nature, and they're then moving their assets to the LTC or to the trust as they change their mind and realise that their funding structure is wrong or whatever. And the result of this is they're now getting caught with bright line rules because they bought a property and they're selling it to themselves within 2 years. So you're paying tax on the gains. So the moral of that story is get your structures right at the beginning, because you don't have the flexibility to change things like you used to. You get taxed on related party sales. And another thing to think about is let's say you've had an asset for 20 years and you decide to sell it to your trust, and then the trust decides to sell it back to a company. Well, you've sold it after 20 years to the trust. That's not a problem. That's not taxable. But if you sell it from your trust back to a company or move it again within 2 years, it's taxable on the gains. That's catching a few people out. Residential land withholding tax comes in July this year. It's going to be another spook for foreign investors. So 1 July onwards, draft legislation only. It's applying bright line rules to foreign investors and requiring them to put essentially 10% of the gross value of the property into the IRD's coffers, or 33% of a profit calculation, which is defined. So essentially, if they want to sell within 2 years, they have to bond the profit and then file a return to get any wash-up released, or if they owe money, they have to pay the top-up. That's going to scare a few investors. I don't think it will stop the market. They'll digest it and move on. They have this tax in America, so it's not that uncommon. Last tax thing to tell you about is for people with high incomes in the room who are self-employed. This is a good trick. And so if you've got a high income and you're self-employed, listen to this. Ordinary companies with large accumulated retained earnings, for example, you've got $1 million that you've left in the company at 28%, and you haven't paid, you've paid the 28%, but it's sitting in the company and you're getting a tax deferral. If you declare a dividend, you're going to have to pay tax on the dividend as you declare it. So you've paid 28%, which is $390,000, but when you declare a dividend on that $1 million, you're going to have to pay the withholding tax or the top-up tax on the difference between the company tax rate at 28 and the trust tax rate at 33. That's the 5% difference. And in this case, it'll be $70,000. However, if the company elects to be a look-through company, and businesses can do that, they're not just for property, then you can declare a dividend without paying that withholding tax, because the declaration of a dividend through a look-through company doesn't incur an imputation regime. It just flows through to the shareholder directly at their marginal tax rate. So in this case, when you actually elect to be an LTC, you release the retained earnings, and there's no requirement to pay that 5%. So you can save that $70,000 on this example. So anybody who's self-employed with a company with a large amount of retained earnings sitting in it, you can elect LTC and avoid that 5% top-up tax. Here's the catch. You've got about 8 days to do it. Because the IRD are onto this, and it's specifically not tax avoidance, okay? So, but you've got 8 days to do it because they're changing it on the 1st of April. So get advice urgently and nail that urgently, because that's free money for you. We will skip GST. That's it. I hope you've enjoyed that. We're going to invite Tony back for Q&A and John back to the stage. Thank you all for your time.
Thank you, Matthew.